This is a really important chart. I would assume I have this in your notes for you. Good. This shows start to finish everything we've done chapters 1 through 4. The first thing that you do when you're presented a transaction, you analyze it. This is not going to work. Oh, it's working. Okay. You analyze it. So you pay cash for supplies. You sell something on account. The owner invests money. The owner withdraws money. You're analyzing all of that first to decide if you need to journalize it. What happens after journalizing? Starts with P. You post to the ledgers. And when the ledgers and the journals are full and the month, the fiscal period has ended, you would then prepare the first of 3 trial balances. One of 3. From there, you are going to both journalize and post the adjusting entries. And then you prepare the adjusted trial balance, the second of 3. As we've been doing throughout the chapters, at that point you could prepare the financial statements. They do need to go in a certain order: an income statement, an owner's equity statement, and a balance sheet, in that order. So those steps really have driven chapters 1, 2, and 3. In this 4th chapter, you learned that it's not even formal here, but we could even say that you could do an optional worksheet. Remember, a worksheet's just a tool to help you build stuff and get stuff ready to close the books. It's optional. That's why they didn't put it on this giant wheel. But that's what we talked about. We learned about journalizing and posting the closing entries, which we know is zeroing out which kind of account, temporary or permanent. Temporary, good, accounts. And then you do a trial balance for the 3rd time, which is called the post-closing trial balance. So overall, we journalize and post, have a trial balance. We do adjusting entries, we have an adjusted trial balance. Get some financial statements ready, then we close the books, and we do a post-closing trial balance, 1, 2, and 3 times. And that's the full accounting cycle, no matter what kind of business you are. A giant corporation or a little lemonade stand. And you've seen it now through the course of chapters 1, 2, 3, and 4. You heard our cooperating professor say the first 4 chapters of accounting are so fundamental. And now we're just going to, we'll keep doing this kind of stuff where we might do new types of transactions, or we might do a new type of financial statement, or we might, we're just going to focus on certain stuff. That was one big piece of this section. I really just want you to know the vocabulary for what I'm about to show you. You're never going to have to do a transaction. I probably should, but it's just the college said we could omit this. Reversing entries are optional. Correcting entries could be avoided if you don't screw up. So here's what reversing entries are. You can either adjust the adjustments, or you can fix oops errors. And reversing means we're going to do the opposite of what we did and then do a correcting entry. So like when you look at an adjusting entry, it's the process of reversing entries to start the next fiscal period. It's basically the exact opposite of an adjusting entry. So when we use supplies, it's a supplies expense and supplies. That's the adjusting entry. The next fiscal year, you would just go do the opposite. They're just kind of weird. They reverse what you did. Or, of course, they reverse errors. Correcting entries, you don't have to do if you didn't make mistakes. And you want to try to do them as soon as possible. So if I said I paid cash when I bought something, but I really charged it, you would want to go in and fix that. You would want, you know, cash would have been the credit. Well, it really should have been AP. So then you like reverse it and then you correct it. We're not going to do them. I just want you to know reversing and correcting entries allow you to fix mistakes. Because anytime there's humans involved, they can happen. I'm just going to rip through these because we're not even doing these. I want to get into talking about the classified balance sheets. If we have time, we'll start the problem today, but I doubt we will. Now, I see a very familiar set of terms here. I see balance sheet. It's one of the first things you learned about in Chapter 1. It's got a new name. It's got classified in front of it, but let's just review what a balance sheet is. It lists your assets, and then it lists your liabilities and owner's equity. You know that. That's a balance sheet. A classified balance sheet complicates things a little bit, or you might say it categorizes things better. Here's a few vocabulary bits that go with it. Instead of just saying assets, they give you up to 4 subcategories of assets: current assets, long-term investments, PPE, and intangible assets. So instead of just saying assets, or me saying this is my accounting class, I have 11 seniors and 1 junior. So I could say college accounting, seniors, list them, list them, list them, list them, juniors, Bradley, okay? It's just targeting in the kinds of assets and giving them a heading or a name. Under liabilities, we have current and long-term, and then owners is just owner's equity. So really, it's this premise. We're just putting labels out here, list, 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 another label, list, 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 another label or another type of asset. So we're going to start with the assets. You can have up to 4, and I've seen the book. Rarely will you have all 4. You're going to need to know the 4 little mini camps and who goes under what. But here are the 4 big ones, and I'm going to break it down subcategory by subcategory. And I think you'd have these illustrations in your supplemental notes. So let's first talk about current assets. So we're under the asset umbrella, and we're talking current assets. Assets that a company expects to convert into cash or use them. The key word here is 1 year. So you're going to sell stuff that will produce cash, or you're going to use that up within a year. Here's a listing of some really common ones. Cash is already pretty liquid. Cash is cash. Typically will show up under current assets. However, if it's a pile of cash that say you are investing and you're not going to touch for a year, then it becomes a long-term investment instead. Short-term investment. So anytime you see within a year or the word short-term, it would be considered current assets. Why do you think AR shows up under current assets? You hope to get the money ASAP. Do you think some ARs could be a long-term investment though? Yeah. Inventory. Why are we seeing an inventory here? You're selling the stuff. I would assume the inventory at Town and Country, they're going to turn into cash within the next year. Prepaid expenses and other current assets, sometimes there's just a whatever doesn't fit somewhere else. I'm actually surprised we don't see supplies here. I'd maybe list that on your side margin. You're going to use your paper and your pens and your staples within a year. What would be some current assets at our school? Well, you're actually, we don't own you. However, you would show up on the income statement as revenue. Okay, good. The food that you just ate at lunch. The toilet paper. Light bulbs. The paper for our printers. Okay. Would all be current assets. Our school is going to use them within the fiscal year. Long-term investments then are any money that you tie up from your business in stocks or bonds and other companies, or things that are going to be around. Now here's a really tricky one. Long-term assets like land or buildings, but they're not necessarily currently being used in the operation of business. Because I'm going to show you the next one is PPE, property, plant, and equipment. The key here, if it's a land or building, but it's not currently used in the operation of the business, it would be considered a long-term investment. Maybe some people have bought themselves a lake lot, so then when they retire, they're going to go build their retirement home there. That wouldn't be considered PPE because it's not used in, like, you know, I'll use Superior as an example, and I do not know. This is just me guessing. Maybe they've purchased some land somewhere and it's just sitting there in hopes that if they expand down the road, they could use it. It would actually show up as a long-term investment, not property, plant, and equipment, the one I'm about to tell you about. So if they own something, but yet it's not part of like the revenue generating activities of the business, it would show up here. Our school isn't doing this, but let's say we owned the land. I got to get my bearings straight. So this way, we owned the land from here out to the bypass, but we're not using that for Phi-Ed. We're not using it to build a bus garage. We just own it, but we're not using it for our day-to-day operations. It would show up under long-term investment versus property, plant, and equipment. Does that help square that away? PPE, I'll oftentimes call it PPE. I want you to get used to writing PPE because property, plant, and equipment is a lot to write out. Property, plant, and equipment have long, useful lives. We're not going to convert them to cash or use them within a year. The key here is that we are currently using them to do business. And there's that contra asset piece that's attached to it. We're going to learn more about this. If I remember it, it might even be the next chapter. That is kind of like that car driving down the road with a big old accumulated depreciation thing attached to it because it's devaluing the equipment. So land or land improvements. Well, what in the world is a land improvement? You got to pay to excavate it, if you have to pay to clear trees, to make drainage so you don't flood out every spring. Those are improvements you make to the land in order to do business. Your buildings, any machinery. For us, let's start listing at school. What would you say are some of our PPEs at our school? They're cute and yellow and they get the kids from point A to point B. The school buses, absolutely. How about the bus garage that the buses are in? How about our building itself? What else? All the furniture? Okay. I don't know where these bad boys fall. Technology. I mean, we're not throwing it away after a year. So it's probably, you know, like technology, computers maybe would show up under PPE. The big one here is that you got to remember it doesn't hold its value, so you're always going to have the less the contra asset there to offset values. The last one's a really hard one to grasp. Intangible assets, so stuff you can't touch. Goodwill. Let me explain this one. It's a weird one. As soon as I give you an example, you'll totally get it. When Superior bought out Westmore, there was goodwill that came with that. And who decides how much that's valued at? That's not for me. But when a business buys out another business, you kind of get that feel, the warm fuzzies that go with it. The weird part is, from an accounting brain, how do you quantify that dollar amount? A couple years back, Bass Pro Shops bought out Cabela's. There was goodwill that went with that. That there was a look, a feel, a core value, a strategy, you know, like that went with that name and that concept. It's just you can't touch it. Oh, there is that goodwill. Let me touch that. You can't. It's just such a weird thing to quantify, though. A film library, customer lists, cable television franchises, sports franchises, brands, trademarks, and other intangible assets. One that's not on this list that will show up once in a while, patents. You own that intellectual property that you can't touch. Yeah, you can go touch the thing that the patent came from, but that patent isn't untouchable itself. It's that intellectual property of whoever created it. And if they happen to work for a business, then the business owns it. When I say Minnesota Twins, it's a brand, it's a sports franchise. Yeah, we can go touch Target Field, and we can touch the infield. We can touch TC Bear. We can touch the players. Okay, but that the untouchable is that brand or franchise surrounding it. Let's go to the other half of the balance sheet. Notice it's classified, though, because it's subcategorized, if you will. Let's talk about liabilities next. Current liabilities. Now you know what current assets are. When do you think we're going to pay off these liabilities if they're current? Within a year. Second bullet point, usually list notes payable first, followed by accounts payable, other items to fall in order of their magnitude. Now, to me, doesn't a note payable seem like a long-term thing? The trick is, if it's coming due that year, it's considered current. So when you just have a little bit left on your school loan, or if you have a little bit left on your car loan, or you're nearing the end of your home mortgage, it would be considered a current liability if you're going to have it paid off within the year. You look at this as a measurement of liquidity. Are we going to be able to pay these obligations or these APs or these IOUs or whatever you want to call them within the next year? So it's us owing money to people, and whatever's going to get paid off that year is considered a current liability. Long term, of course, is anything beyond a year. You may see notes payable happen here as well. I'll be honest, we'll get into some of the problems. Sometimes it will say you have a $10,000 notes payable. $2,000 will be paid in the current year. The remaining balance will be paid later. So you'd put notes payable of $2,000 under current liabilities, and you'd put notes payable of $8,000 under long term. Whatever's getting paid off in that year gets attached to current. And then we get into owner's equity. We talked about these before. If it's a proprietorship, like what we've been talking about, it's just going to be like in the example we did with our quiz, Jones, Capital. Yesterday, Mars, Capital. If the Bens and I are in business together, it might be Ben, Jenny, Ben, comma, capital. Or it'd be Ben, comma, capital, Jenny, comma, capital, Ben, comma, capital. But then if it's a publicly traded corporation, it's shareholders, capital. We won't get into that in this class. Remember, this number is forced. We would have done our income statement. That owner's or net income would have been given to the owner's equity statement, and then from there, factored in down on the balance sheet. We did it. Do you like classified balance sheets better? What do you think? They're a little bit more cumbersome because you're categorizing and subcategorizing, but it also makes it very streamlined too. We have 10 minutes. I want to start a problem today. We won't, what? I just have to remember which problem we're doing. I think we're in here. It'll be in the deal. I just don't remember which one it is. Here she is. I think it's exercise 414. Look at you just diving right in and finding that thing. All right, we have a bowling alley. This is exciting. There's 3 columns, isn't there? Boy. We won't get very far, but we're going to just try to get as far as we can. (414), right? Exercise 414. Okay, so you actually are going to use the top of page 198. Prepare a classified balance sheet. What year are we dealing with here? 2014. Okay, and it already tells us something a little bit about the notes payable as expected. Assume that $22,000 of the notes payable will be paid in 2015. So let's look at notes payable before we even do anything else. Notes payable is sitting there at $97,780 minus $22,000, because that'll be like long term. $22,000 will. The rest of it's going to be paid within the current year. 198. So they have them all jumbled up by debit and credit. They have them all jumbled up by debit and credit. Some of them we are not going to need on the balance sheet. Like expenses don't show up on the balance sheet. Revenue doesn't show up on a balance sheet. They're factors in figuring out owner's capital though. I'm not telling you you're going to have all 4 of the categories for assets, but let's list them. What was the first subcategory of assets? Current assets. Which one was another one? Long-term investments, PPE, and intangible. All right. So let's start with the first one. Current assets. That is a heading. You have, I'm going to call it the left column, the left and the right. The right column is when there's not any more math involved, really. I mean, it's like like notice this number right here is showing up in the left column because eventually we're going to need to add up all of our current assets. Does that make sense? So cash is one of the current assets. $18,040. Look at that list on the top of page 198. What else do you think we are going to either convert into cash or use up within the first year or within the year? AR. Let's go with AR. I heard some of you say land and equipment. That's going to be around for a while. PPE. Why is AR a current asset? Kenzie told us once. Someone else tell us why. We want it, and we want to get it now, or for sure within the next year. One more. Yes, you're going to use that up. Typically, it's a 12-month policy or less. Spoiler alert, those are the only 3 current assets. So what we're going to do is single rule and write total current assets and put the total, or what I'd call the subtotal out there, because we're going to have a few more out there. If you're into highlighting, those go together. You've got a heading, subcategory, 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 and then let's total them. Does it appear we have any long-term investments? Not really. It would usually tell you, like not even listed there, but it would tell you of the cash, 5,000 is wrapped up in stock or bonds. Okay, what would the next heading be? And I'm cool with PPE, not property, plant, and equipment. PPE is the stuff that's going to stay around for a while. We're back to, well, and let's just list land first. It wouldn't be the end of the world if you listed something else first, but notice we're using the left column to do so. My best advice as you try to figure out what goes together, do you see accumulated depreciation on the building and then accumulated depreciation on the equipment? Those are 2 contra accounts that have regular assets that go with them. So now it's when the left column comes into play. Like, look at this. Look at what they did there. Buildings, and then in the next line, less accumulated depreciation on the buildings. So if I had to put some math in there, I'd go like this. So do you see why you have the left column now? And then what do you think is going to happen next? Same thing. Equipment, less accumulated depreciation on the equipment. So then you're sitting there with land, and then kind of the snapshot of the buildings, the snapshot of the equipment, so 67,000 plus those 2 snapshots, when added up, come in at a value of 196,880. Nowhere in that list do I see goodwill, patents, franchises, brands. So it tells me, even though we have 4 subcategories, we only listed 2 because we didn't need to use the other ones. PPE. I wish it said total PPE underneath. Can you have a total PPE line for me? That would make so much more sense. Like it's missing. I would say it's right here. I want total PPE, which is 196,900. I would actually bump that number down a line. It's my wonky textbook not doing it that way. So our four assets, current assets, done, check. We didn't have an investment. PPE, done, check. We didn't have an intangible, so now we can say total assets. Because of ALLO, A equals L plus OE. So you would double rule underneath the, you're single ruling anytime you have math above. So that's why you see some single rules under buildings, you see some single rules under equipment. Yes. Yes. Because the 43,680 has math above. So do you see how I made the change of you're putting total PPE on its own line? And then we've got total assets. Talk about an awesome use of our class period today. Thank